You have questions, we have answers. This is Jane Miller.
And this is Ken Miller. Welcome to our show, all about real estate with Ken and Jane. So today's show, we are going to continue our discussion of commercial real estate 101. And Jane, I know you were complaining to me since last week. You had a big headache. You said, you should have warned me. You didn't get me the coffee. So where's your coffee today?
I forgot too.
Oh, man, you forgot it. So you're going to have to pay extra attention again, right?
That's right.
All right. So you ready?
Yes.
All right. So last week we covered a lot of the terminology of the different types of commercial property classification. We covered a lot of the different leases. I'm not going to go through all that because we want to get to some more information today. But just as a quick overview, we covered there's commercial leases, there's gross leases, and then there's leases where the tenant pays. They're called triple net leases, where the tenant pays a base rent plus the property tax, building insurance, and the common area maintenance, the three nets. And we're also going to now talk about a very interesting type of lease called the percentage lease. Percentage leases are typically found in the retail setting, and they involve, they're very similar to triple net leases in that the tenant will pay a base rent and they will pay their pro rata share of the triple net costs, which again are the property tax, building insurance, and the common area maintenance. However, they tend to be, the theory behind them is that they tend to give the tenant a little bit less than market value base rent, but they have a clause in them, that's where we get to, that's what defines as a percentage lease. They have a clause in them that states if the tenant reaches a certain gross revenue in the given year, then which is whatever they define it as, it's called the break point, then the tenant will be responsible for paying the landlord a percentage of the revenue exceeding the break point. So I know it sounds confusing, so let's do an example and it'll be much clearer.
I think, sorry to interrupt, Ken. I think this is more kind of the landlord say to the tenant, let's grow together.
Right, that's
okay.
what, yeah.
Let's grow together.
Yeah.
I give you a break, sometimes if you ask tenant, they think you didn't get a break. But anyway, from landlord perspective, right, they feel they give you a break on the rent. But to help you, especially the beginning, right, the first year is always the hardest time to establish yourself. So they give you a reasonably rent and a plus a percentage, which is once you reach a certain point, the landlord feel if you're doing well, I should have, share the success.
That's exactly right. We want to work, I'll work with you, but as you grow and do well, then he wants the landlord, he or she wants a percentage of that success. And they're willing, because by them working with you and hopefully giving you a little reduction on the base rent, they want to be rewarded if that tenant does do well. Yeah. So let's do an example how this would work. A lease, for example, a percentage lease clause might read something like, if the tenant's gross revenue exceeds $800,000, then the landlord would receive 5% of the rent in excess of the $800,000. And in that example, the $800,000 is the break point, and then any revenue that the tenant earns in excess of the $800,000, 5% of that would go to the landlord. So let's say in a given year, you have a coffee shop and they do a gross revenue of $1 million. Okay, so $1 million. The break point in the example is $800,000. So anything over, so that would be $200,000 over the break point. So the landlord would be entitled to 5% of that $200,000, which comes to an additional $10,000. Mm-hmm. So that's just another way. And then and obviously the tenant did even better. That money.
But that's a gross income, not a net.
That's a gross revenue. Yeah.
So that's a lesson there for the guys, for anyone want to operate your own business. You really have to work on your business plan. How remember there was story about what's that a company? They have an endless shrimp. At the end, the company went bankrupt or closed.
You're going to get spoiled
red lobster.
Lobster, right?
Think about it. If you were one of the Red Lobster, I don't know, they do franchise, right? If you franchise one of those, and as a small business operator rather than a big corporate, and then you the revenue look is so good because endless stream, everybody come, you have $1 million growth, but actually, even you lose money, you still have to pay this to the landlord because that's based on the gross income, not on the net. So I think in a way, this kind of lease is further, in my opinion, is helping the business owner have the focus on what's net at the end, right? How you run your business in a way. Right?
Oh yeah, because they're good. But again, it's only on the excess. It's only anything over whatever the break point is, and the break point, I guess, that's a negotiable item. Obviously, if you're the tenant, you want the break point as high as possible, right? And if you're the landlord, you want it as low as possible. And I've been involved in situations where we say no, we want the break point to be 1.2 million. The landlord says no, I want it 600,000, and they have to. So that's the key factor, right? Yes. Because the higher it is, the better for the tenant. The lower it is, the quicker it's reached, and then the landlord gets their percentage of the excess.
That's right.
So, and like you said, it's all the attraction is the concept is that the base rent would be set lower than it would be on a standard lease to make this somewhat fair to the tenant. Otherwise, it's. So
it's not a fair, not fair. It's a give. I mean, like I said earlier, it's a give them a hand at the beginning, like a grow together type of style. It's like if you running a business, if you have a very good coffee shop, you have a very good hair salon, right? If you do this and then. The landlord hope you'll be there forever, 5, 10, 20, 30, 40, 50 years, right? And so it's mutually benefit because in any retail store, right, especially in a small mall or in the big mall, so the success of the location is based on each individual operator business, right? If you have a 2, 3 very popular spot, everybody, can get benefit. It's all the traffic.
That's why you call them like anchor stores.
Yeah, exactly.
Scale. Those are the ones that are the anchors that hold down the fort kind of, and that draw the other ones, and the other smaller stores usually they rely on them, the big daddies, to pull in the customers.
Pulling the customer, Sometimes could be a middle or small customer, but very unique. They have a lot of people just go there, I mean, that's really, I think or
you could have a combination of a lot of, you could have all stable customers that are all unique, but they're all have their specialty attraction. You can think of almost like a, I don't know, in Central Jersey, almost like an H Mart, right?
Yeah.
Where you have a lot of different stores, but they're none of them is really, I mean, you have the market itself, but you have a lot of restaurants. They all have different, they all have different cuisines where they are competitors, but they're slightly different. Even if they're Asian, they have different styles, different regions of Chinese.
And everybody benefit from each other. When we go there, right? If the place is full, and you can go the next door or try a new place, right? Yeah. So I think everybody. Feed on each other, benefit from each other.
You have those.
The spa. You have the.
You have the Paris Spaghetti. You have the other specialty dessert places.
Yeah, you have everything.
There's enough for them to thrive. Yeah.
Yes.
Do well. Yeah. So that's right. It doesn't necessarily. So the anchor doesn't have to be this big giant. You could have, like you said, a more complementary, even distribution of the stores.
Yes.
Yeah. All right. So now we're going to focus. The next topic in commercial I want to cover is the market analysis. In commercial real estate, like residential, supply and demand are the key factors in what drives the commercial real estate. We heard this. We've said it on many shows. Maybe every other show. Every time we do a market analysis, it all comes down to. I know it sounds simplistic, but it all comes down to supply and demand, right? Yeah. Those are the things that set the market price. If they're in balance, the market is in equilibrium. But if they're not in balance, if they're in imbalance, then you have fluctuations in the market price, which we're going to cover. So what is supply? It refers to the amount of commercial real estate available in the market. This would include office space, retail space, industrial properties. What are some of the factors that affect supply? Well, number one, you have new construction, right? If there's a lot of new construction going on, when more properties are built, the supply increases, whether you have more warehouses, which they've been trying to do in New Jersey to try to catch up with the demand. So what do?
Especially more A class. Yeah.
Right. Well, they're all being built by, all the new ones. Nobody's building a small warehouse. They're building their few 100,000 square feet. Yeah. And you're not going to find a brand new warehouse that's 10,000 square feet. They want to, they're multi thousands and thousands of square feet. Right. So you have new construction. Vacancy rates. If there's high vacancy rates in an industry, then that affects supply. For example, the office market was wrestling with a vacancy rate of around 20 to 25% in the recent times, over the last, in 2024 certainly. So it's quite high, right? Because of, like we covered, because of the e-commerce and the COVID and the fact that people, the remote working and the technology, the Zooming, and so there's a slight.
I saw someone said there's a lot of the office building. They convert them to residential.
So I was at a convention too, and that's been on the news too. There's been in Los Angeles and in Manhattan, there's different projects going on, but it's not always, from what I understand, again, I'm not an expert in that, but it's not always a given. You really have to evaluate the structural integrity of the building and see if it can be done with it's costly to do it. That's what a lot of people don't understand. They said, you just take this office building, let's make it residential, but there's a lot of work involved, and you have to also evaluate the structural integrity to see if you need underpinning for the added support and the weight. So there's a lot of different things, but there are companies and brokerage that specialize in that, finding. There are clients, investors that look in that particular field. They want to find buildings that are suitable for conversion, and that is a growing field now, because they have to find a use for these buildings. So in the residential, there seems to be always a demand for more residential housing. I know New Jersey has that, right? We have there's a shortage. So
I think even I'm sorry, jump around. Even the some big mall, like not doing well. So maybe that's an opportunity to convert them to mixed use. Upstairs is the townhouses, the first floor remaining commercial.
Right. And mixed use is a very popular trend among the developments we're seeing in New Jersey now. We have the retail, office on the lower level, then built it up. You have maybe townhomes above it or condominiums. You're seeing that in different towns in East Brunswick and Woodbridge. On Route 1, there's a lot of different, they're all popping up. So it's very popular concept now. Have a community, then have the residential, the commercial units below it to supply, that can supply the general public, but also supply the residents of that community, which might be a few hundred residents. So
I come from Asia, I mean, that's very common in upbringing,
Yeah,
you
and
have
it's convenient too, because if you're living,
especially
living in the suburb, if you're in a residential complex and you have a cleaner, you have a fitness place, you
don't need a car really.
Below, you can can be like a sort of a self-service, and and the residents help support the commercial, and then the commercial can gets their services to the residents there, and then as well as whoever else would come to that.
That's right. You really don't need a car.
Unless
maybe one car per family rather than 2-3 cars.
Right, especially if you work remotely, right? Then
that's right.
Yeah, you can you're self-sufficient. So. So those are the things we're going to cover. Then there's, like we covered, renovations, which you hit upon. So we're going to take a short break, and then we're going to continue our discussion on the supply and demand. Okay, welcome back to our show. So we're going to continue our discussion on supply and demand in the commercial real estate world. We covered that supply is influenced by the new construction, by different sectors have various vacancy rates that are going to determine supply, and also the retrofitting and renovations done to the existing buildings. Now let's flip to the other side, the demand. Demand refers to the need for commercial space from tenants, investors, and businesses. Factors that drive demand. Obviously, number one would be the economic growth. When the economy is strong, businesses want to expand. They want to open more additional stores for whatever they service. That would assert a higher demand for office space. It could be industrial space if they need more product. If they're producing more product, they're selling more product. They need more space to warehouse it. Retailers, the same thing. So a strong economy, obviously, that's a kind of self-evident. That's higher demand. Industry trends, and this is what we've touched upon. The rise of the e-commerce, for example, during COVID drove the demand for the New Jersey warehouse space. So things that happen with different trends going on, right? So people buying online, shopping online, that has hurt a lot of the brick and mortar retailers, but it's helped the e-commerce industry, the Amazons of the world thrive, and then they need them and their distributors. They need different warehouses. They need more space so they can get their products directly from their warehouse to the to the consumer.
Yes.
So but they just bypass the retailer. So in essence, the warehouses become these large just retail outlets.
You know what, Ken? You're right in a way. They bypass retailer, but I saw a lot of smaller or bigger retailer. They just change form. They didn't get bypassed. They set up shop in Amazon. They set up shop online.
Right, or they have the option where they can.
Yeah, exactly, like Walmart.
So hopefully
that's online.
Yeah, so hopefully that's the adaptability, right? Because when one job gets replaced, but you have to adapt, right? Everybody has to adapt, because as in essence, with the change of the moving times, right? So like with AI coming on, that could eliminate certain jobs in the factories and maybe certain cleaning jobs. If they're talking about maybe the next 5 years having the AI robots that you can pay maybe $15,000 or $20,000 and they can go around and they could do your cleaning, your laundry for you. It's not that far off.
I just want a self-driving car.
Yeah, that's right.
And I can go anywhere.
Yeah. So but things will change. Like there'll be more jobs in the AI and that software and things, and then there'll be more jobs for the technologists to fix the AI when they need when their brains need recharging, or they don't charge, or the battery that they overload or something, and they're stuck in the middle of doing something. You never know.
One of my clients told me he's in the head of AI department and doing great things out there. And he said maybe in 5 years, there's no, when you apply college, right, there's no major in the computer science because a lot of programmer will be replaced by AI.
Where they can teach the AI how to do.
I said, thank God our daughter is going to do the, non-STEM is going to do the political science.
Well, AI has involved so much now, even with computers, like in different things. Like it used to be in like the chess field. It used to be like the top players back in the day, like the Gary Kasparov. They could hold their own against the top computer at that time, which was Deep Blue. But now, as an example, the top grandmasters, the super GMs, are rated maybe like 27 to 2,800, maybe the top 10 in the world. And even the greatest player, like a Magnus Carlsen, against the AI, the super bots or the supercomputers, they're rated like 3,500.
Oh, my God!
So they can crush. I mean, because there's just the calculations they can do, and just there's no comparison. They're just going further and further away. So like everything, AI is just a part of life, and it's going to be here, and they got to use it for it can help us hopefully, and hopefully it won't hurt us.
Wow. Let's see. Let's wait and see. Yes.
Yeah. So obviously, industry trends, economic growth, population and demographics are going to affect the demand based on a large population area. You want to go with, if you have a business, you have to look at what the demographics are, what the population is. That's going to affect the demand, right? Mm-hmm. And what's the competition that's there. That's all going to depend upon what the particular demand is, for that type of service that your client has. Yeah. So you have to understand, when you're looking for a client, the whole picture. So when the demand for commercial space is high, but the supply is limited, that's going to create the rents to increase, right? That's the kind of obvious. And then there's other factors when the demand, when there's an increase in supply with stable demand, that's going to cause the prices to fall.
Yes.
Right. So there's going to lead this could be caused by if there's higher vacancy rates. Yeah. It's going to have lower rental incomes. Just for example, the office market, it's not going to command the top dollar that it once did. I mean, with very few exceptions. I think the Class A offices, there's still enough firms that particularly want the Class A space, so they're going to pay. So that really hasn't dropped significantly as compared to maybe the Class B and the Class C, the lesser offices in terms of amenities. Equilibrium would occur when the supply and demand are kind of in balance, and then the market is kind of stable. That you have like the market rate. However, either an imbalance with either an increase in the supply or an increase in the demand will cause an unequal balance.
You know what? It's very rare they equal. I mean, they may equal in a very short period of time. They always very fluid, right? I remember back to 2011 and 12. I mean, residential market, as everybody remembered, was a disaster. It's vacancies everywhere. For the short sale foreclosure, it's very hard to sell a house. The market dropped 20-25% from the high 2005, 6, 7. By the time if you purchase house 2005, 6, and 7, you want to sell 11, 12, rule of thumb, roughly 20-25% you lost, right? If you have to sell. But I remember that time with the commercial, the warehouse have a lot of vacancies. I remember that time.
Yeah.
11 and 12, because that time I have I start real estate business 2009. I remember that 11, 12. There's a lot of vacancy everywhere when you drive.
And it used to be, sorry to interrupt, but it used to be with the warehouses that they were in the single, and again, in the post-2000s, well, in the 2005, 2007, 2008, they were in the single digits for base rent, and and then they jumped into the like the 12s, then to the 15s.
Yeah,
and now
I was shocked because that time the retail is that much that time.
Right, and now with the new construction warehouses, you've got all different rents in the in the 20s, for the modern facilities. So it's gone up quite a lot, and then the older buildings have held their own too because of the demand is still there in Central Jersey. They want to be close to the port, so that's what affects demand is the location. Besides the vacancy, they want to be if you want to be close to the Newark port or within 45 minutes to an hour, but if you go to South Jersey, you'll see a little difference. You'll see a variation in the price. Based on the geographic location, there's not that same demand because the distance becomes a factor, right? Because time is money, so people have to take their trucks 2 hours as opposed to 1 hour. It's not. They have to calculate, is it worth where do they want to be? And
absolutely.
You want to be in Gloucester County or you want to be in Middlesex County?
Yes.
Right.
Got it.
All right. So with commercial, there's different investment strategies, which is the next topic we're going to talk about. There's called the buy and hold, there's called the flip, and then there's called the development. So in commercial property, like there's different strategies that, depending on different investors have different aims. The buy and hold is a strategy where you purchase a property with the intention of holding it for a relatively longer period of time, at least a few years, and you're banking on the fact that the building is going to appreciate in value, and you're going to get the rental income on top of that. The goal of it is really to generate a steady rental income, have some, have that income coming in. You're looking for long-term property appreciation. That's not uncommon, not too much different than with residential, right?
Yes.
There's a strategy too, with some people buy residential investments because they would just have the intention, they want to fix them up, make them very suitable, and then rent them and hold them until they're, for the long future because they want that steady income. They don't want to sell it and have the capital gain.
Yes.
So this is likewise in commercial. It's very similar. It's the buy and hold philosophy, which I think a lot of clients employ. So it's considered a more safer in terms of the commercial. I mean, commercial real estate, I would say we should cover in terms of investment risk. It's somewhere. It's less risky than stocks and those types of investments, but it's a little bit riskier than the bond. So it's like it's considered the medium between the two extremes.
I think I could be wrong here. Maybe I'm biased here. I think the commercial real estate is more risk than residential. Because you see, if you have an office, right, and you drop the price, if you drop a little, you still vacant, right? But the residential, if you drop slightly, the people will come.
Right,
so
and that's why with the office market there was a lot of problems in the cities where a lot of the landlords were getting there was a lot of default on some of these mortgages because they were getting slammed because they had 40% vacancy and they're not able to pay the commercial backed loans, and so there was a lot of havoc caused by the whole COVID and things. So you're exactly right. That you take a risk, so you really have to know the industry. Everybody now would say, "I want to invest in industrial because that's where the profit is, the money is." But then you're going to be paying a higher rate, obviously, to get into it. So you're banking on that. It's still going to be highly profitable right now. If you mention industrial, you mention truck terminals, you mention vacant, industrial land. You really have to have the expertise, understanding what you get into. It's not like you meet someone on the bus, they told you to do something, make money, and the next thing you do the same. Right. You need really a lot of research, understand yourself, understand your strategy, and hire a professional.
and to give you the good advice.
Absolutely. Just like with anything you invest in, whether it be a stock or a mutual fund, there's no easy way to say, oh, my friend told me this is a sure thing. There's no such thing as a sure thing or an IPO that comes out of the market, or you can get into this group, look at all the poor people that have, they had an American Greed, the people that said, oh, they were sold something that's a sure thing by a group, and it comes a Ponzi scheme, and then you lose everything. So, right, you have to be careful, and you do your own homework and do your education. Don't run into anything. If it sounds too good to be true, most of the time it is. It is. You're going to pay, right, because otherwise you're not going to beat that market, whether it be even with commercial rate of returns. You want that. A lot of properties out there, a lot of investment properties out there are offering maybe a 5 to 6% rate of return, but a lot of investors I work with, they want that 7 or 8% rate of return. So you have to try to find something, that's
used to be 7-8% return for commercial is common 15 years ago. But now because the price is so high, that's all associated with the price. If the cost base is high,
and you have to look at your clients' interest rates. If the commercial interest rates are like closer to 7, they need to at least cover that if they're going to
more than 7 now. Residential become almost 7.
So that's all. That's all the market conditions dictate. What the rate of return has to be for the investment to make sense.
Yeah, absolutely.
So, all right, let's talk about the other second type of investment strategy is called a flip. That's where the investor buys a property with the goal of holding it for a short period of time, making the renovations to it, and then selling it for a profit, which usually the selling time would be a few months to a year or so. The flip properties tend to be properties that are fixer-uppers, distressed properties that need some work, and the idea is that the investor says, "Hey, I'm going to take this property, I'm going to improve it, and you know what? There's enough money. Once I improve it, there's a margin of profit for me, and I can sell it to somebody." That's kind of what it is. You see that in residential too.
Yes.
They have a different goal. They're just want to get it. They want to buy it below market. They have to do their calculations. There is a little bit more risk involved than a buy and hold, because you have to calculate, well, am I getting it below market? What's it going to cost me in renovations? What's the timeline? Is the contractor going to complete the task within the time? And what if in that all that time, what if the market changes and there's a downturn? So you can invest a lot of money into it. You're investing money to buy it. Usually it's usually as a cash purchase. Then you might invest $50,000, $100,000 or more into it, and then you have to say, well, if I do this, and then is my sale price going to be greater than that by enough profit, and is the market is it going to wait for me to do that? So you're relying on the market to stay put, and you're relying on the contractors that you have working for you to finish the job, which can be challenging. So there's a lot of different factors involved in that. So nothing's easy to make a profit, but that's something, right? So, like I said, it depends on successful renovations, market timing, and ability to sell quickly. The last type is the development strategy. This involves buying a raw piece of land, and then you acquire the raw land, you get the permits, you put a development on there with commercial development on there, and either you decide to lease it or to sell it when it's developed, right? So again, it's very risky too, because it involves a large amount of capital. Mm-hmm. You involve zoning issues, construction delays, weather-related delays. So the reward could be potentially great. However, there's significant risk due to the complexity, the long time frame to develop, and the financial commitments that you have to make to get to the end, to get to the finish line by building that structure. Yeah. So those are the three types. We are out of time, and this is a good point to break. Again, I don't have time to give you any refresher quiz or Q&A, so I think we'll just call it a day right there.
Okay.
All right. Have a good weekend, and we'll see you next week.
Thank you.